Hello ladies and gentlemen, and welcome back. In today's video we discuss this key level and more importantly quadruple witching and the event that really changes the landscape of options in the market. $3.2 trillion is set to expire this Friday, and on top of that we've just seen the Federal Reserve's tapering come into play. So will the markets actually drive lower into what is probably going to be a very difficult thing for them to do? Or is this about to reverse for the Friday session? We'll be talking about that and more. But what's really worrying is probably what's on the horizon. Bonds and yields. They're starting to get out of control. And at this stage, no matter what pullback happens, it seems set to potentially move into levels we've been discussing for quite some time. Remember guys, we're in September, the worst month of the year. Stay tuned as we cover it all right now. Well, welcome back everybody to the Daily Show, and the first place we want to start is by discussing quadruple witching because it's about to occur. Friday's quadruple witching is basically set to expire around $3.2 trillion worth of options according to Goldman Sachs. This is a massive amount of money. Of course, it means that potentially dealers are going to need to hedge positions, and it can drive the markets into some serious kangaroo style action. Obviously, over the last 24 hours, we saw weakness. Often the weakness does come in a day earlier, and then the strength actually comes in during the session of the quad witching, but we don't know that's necessarily going to happen just yet. Of course, we need to look at the evidence in the charts and everything else. So for anyone that doesn't know what quadruple witching is, it's basically the simultaneous expiration of 4 different stock options. We've got stock index options, stock index futures options, single stock futures. And it happens every third Friday at the market close of 4 p.m. during March, June, September, and December. People really care about this because, of course, it creates a lot of volatility ahead of the event and often traps that sometimes traders want to stay clear of. And then they want to see the clarity that comes past this options expiration and of course get into the next week. So why is everything so crazy in these markets right now? Well, of course, it's got to do a lot with this thing here. 95 billion in monthly liquidity reduction is beginning as of September 15th. This basically means that now we're going to see the Fed pledging to run off its balance sheet by $95 billion a month, and it's going to have an effect. So we're going to now start to follow, of course, and make sure you subscribe to the channel if you enjoy this type of thing. We're going to need to start to follow how much reduction the Fed is doing all the time in their tapering efforts, and this will be something that we'll have to focus on now for the coming months. Another thing I wanted to discuss was yields, because everyone's talking about how crazy inflation's getting, but the higher these yields are going, it seems like smart money, if we want to call it that, is realistically starting to place positions into these treasuries. And it may seem counter logic because, of course, the Federal Reserve might be selling into them, but basically we're seeing a sell-off in treasuries that's making them now very attractive to the longer-term investor. Let's take a look at a couple of charts, just put it in perspective. Here's a chart over here, one of the worst medium-term bond drawdowns in 30 years. I can't even remember a time when I really liked bonds other than hybrids here in Australia over the last decade. Bonds have been notoriously pretty hideous, and they've been very, very difficult to find value in. We've now got a 252-day drawdown in 2, 5, and 10-year Treasury note futures, and this is starting to appear into some of the previous periods of time. We've got an alert, basically, that's pretty rare, and it's starting to come into that zone. Now, of course, this is a longer term strategy. You can see here the 10-year note, how bad it's been over time, the kind of level we're getting into again, 252-day drawdown history. Now, when we take those kind of stats and we bring all of the treasury notes and positions together and get these data points, what do we end up appearing into? Well, if you actually look over the next year, and of course this is what the bigger traders do start to position into, 12 months later, in general, when we've got alerts similar to these, we usually see yields, that is the medium and long-term yield, realistically come down, and overall that to become a slightly better investment. And 91% of the time after these signals, you'll see a bullish gain. Now, most of you won't get excited over 5.4% average, but in the bond world, That's not too bad considering. So it's all about really putting it into perspective. We've just got a new survey coming out as well about retail traders and what they think of the market. Interestingly here, even with that big bearishness we saw come through, a lot of retail traders have switched to being bullish over the last week. This is, of course, a survey taken as of Tuesday, just before that drop off occurred. So there was a few people going bullish, and then all of a sudden, bang, we saw that huge fall off in the markets. Of course, we use this as a bit of a counter logic to what people have generally been thinking. And it's very interesting to note that the bearishness dropped even though the market was going down. People obviously seeing, or what they feel like they're seeing, is value purchasing over the long term. That's what you want to see if you're a bear in the market. More people turning bullish is technically a good thing for you. The less people that do it, or the more retail traders that are against you, it can often be used as that counter logic. We already know the big traders are incredibly short in this market. They're underweight equities. They're feeling like there's a lot worse to come. That's just a good data point. And we also know that a lot of big traders do have the puts in this market. So that could be explaining why we're seeing this sell-off, even though a lot of us are expecting the maximum pain level to be reached by Friday. Will we get it? We'll find out, but we'll be taking a look at that a little bit later. And for any new viewers, you definitely want to stick around so we can talk about this maximum pain, because it's a good concept. And of course, it doesn't always work, but it's good to add into your analysis each third week expiration. Are we in the worst month of the year? Yeah, we certainly are. Midterm election years, of course, it's weak around this period. Same with generally in September, around this period is usually where you see that weakness. As you can see here, generally from 1950 to 2021, the weakness has come into the market near the end of the month, and that leads into generally October as well. Here's a quick thing about if we do end up making a new low, there's some bear market charts. Pause the screen if you wish to. Here's also some of the most correlated market conditions over time. Again, pause the screen if you wish to and have a look at some of those. And we're generally following all of these at the moment. With an update, we're probably around here, and around here in terms of the market pullback. So of course, in the bull cases, we should be turning relatively soon. And in the bear cases, we make a new low. There could be a lot more to come. Keep an open mind to both, and we'll be following along with that, of course, generally. If we're talking about seasonality, if we're talking about the idea of markets being weak into September and October and midterm elections, which we've been discussing now for a while, midterms elections usually have a huge amount of weakness before, but they do have a statistically strong period afterwards. So we need to be aware that November into January, November into April moving forward, and even November into October moving forward, often bring big gains. So while the prior term, you can see midterms versus non-midterm averages, midterms are absolutely horrible in comparison. There is usually a very strong gain after the midterm election. So around that 15th of October to the beginning of November, if we run the same statistics that we've always had in the past, this is the way that markets often do move. And you need to keep it in the back of your mind and be open to that scenario. So before we jump any further into the charts, I'd like to thank the sponsor of today's video, which is Tiger Brokers. And this is part 2 of a 3-part series I'm making about some of my favorite features inside the platform. First up, we talk about charts here. So any platform needs to have good charting software. Luckily, Tiger do. Of course, they have earnings. You can see the volume down here. You can chuck your indicators on the chart, and there's a whole bunch of time frames and of course drawing techniques that you can use throughout the platform. You can also set alerts, which is super powerful and a big part of being a successful trader, at least I believe. And you can go into chart settings, change the appearance, display colors, all sorts of things on the platform itself. And you can of course add things on and off. One of the best things about Tiger Brokers though, and I think super underutilized by a lot of people out there, is the analysis and the extra tools that they offer traders and investors. If you want to get analyst price targets, you get them in the platform. This used to be something that was exclusive to really expensive platforms. And it's just a good way of seeing whether it's undervalued or overvalued by looking at the target mean price. Now, of course, a lot of analysts haven't upgraded since the split, but you could still work it out. And of course, if you're using a different stock, it would come up with the right one. But where I think it's differentiated from so many other platforms is not only does it have short interest and all of this information as you scroll down, but you can also click on valuation analysis or short interest and press more. And when you do that, it brings up a chart that has everything about the company that you could want. If you want to see valuations, you can see them here. If you want to see the financial overviews, income statements, balance sheets, cash flow statements, they're all there in one platform. It's so annoying having to go through different platforms and then go and get all the data, bring it all together, and then collate it. Guess what? It's all there. And they're constantly adding more things based on not only your feedback in the community, because I give that to them, but also, I'm giving them a few extra notes as well sometimes about things that can be improved. And this is the beautiful thing. They're taking that on board and they're adding it all the time. So if you're interested in some of these features and all the other features that they offer, of course, check out the special offers in the description down below, or of course, the little pinned message. And there's a whole bunch of things there. If you are from a country that isn't mentioned, you can always contact their Singapore office and see whether they can help you out. But a big thank you, of course, to Tiger Brokers, and check them out down below. The VIX didn't jump very much considering the market moved down. And of course, the market did end up moving down. Nasdaq was down over 2% on the day from the top. It has put a little bit more on. It kind of came down back into the supports. And after hours, during the time of this recording, we're actually even lower than that point. So we'll talk about that as we go through these charts. But let's also begin by discussing yields. So I want to discuss the US 10-year. And you'll notice here the US 10-year realistically is at a very critical point. We've seen a lot of previous supports and this resistance that we had only a few months ago where we hit this 3.5%. And it's the same for the US 2-year as well. If yields are not going to, realistically spike too much more, we're at these critical zones right now. Look at that V shape. That is a huge, huge increase. And of course, we've seen similar style increases in the past, but we're at that critical level and we've just reached it in the last 24 hours. 3.882 on the 2-year. And if we're looking in terms of the future, this is pushing us now in terms of interest rates in April 2023, almost to a 4.5%. So many of your family and friends will have absolutely no idea this is about to occur. This is one of the good things about being in the market, understanding yields. But yeah, it's expected that by April of 2023, the federal funds rate will be at almost 5%. And that's going to be shocking to, of course, the demand story. Will it stop inflation? Well, for anyone that hasn't actually studied the economics of inflation in general, the market has had to have the federal funds rate above inflation. So we're like right up here right now with inflation, 8+%. The only way to kill it has usually been inflation dropping underneath the Fed's fund rate for significant amounts of months. So it'll remain sticky, and then potentially it will fall off. So basically they've got to kill the demand side as much as possible. And in history, the only way to ever kill inflation has been to push interest rates above the inflation number. So imagine going 8% plus in the US. I don't think it's possible. It would completely melt the system. And I've long talked about this idea that we can't really get past the 5 to 5.5%. I think if we get past those levels, we're in a seriously big problem. So hopefully inflation does come down, because we really don't want to go past 5 and 5.5. And I know a few people on this channel are going to say, yes, we do. We want that. Yeah, but you got to think about everyone out there, your family, your friends, the jobs. It's going to be so bad if it happens. And I don't wish that on anyone. I really don't. Dollar index. What's going on here? 109.69. So it's just basically trapped within a bit of a zone. Some people are drawing up like a pennant style position or a symmetrical triangle for dollar index, and they're trying to trap it between these lows and these highs. I think that's fair. And effectively, if it breaks out kind of the top, then we could see it spike. What the key levels that we're looking at here are really around this 110.25. I wouldn't mind to see that get taken and then instantly reject. Will it happen? Don't know. But if it does, that would be pretty sweet to see a little rejection around here. That could really push further down at that point and be like a false breakout. But at this stage, at the time of recording, it's trapped within this zone like a pennant. Some people will try to trade this long. And of course, if the stock market does start to fail and really move down, expect the US dollar to move up heavily. The same with the Swiss franc, which is being very strong at this stage versus quite a few currencies. Let's move over to gold. So this is where things get a little bit sad in some ways, but we have hit a fairly critical level. It's now or never for gold to find some form of support. If you actually load gold through, there's really not much support on this left. I mean, basically gold could move all the way down here to 1582. And that would be a significant problem in terms of there's not much holding it up over here on the left-hand side structure. We've just hit the most recent kind of lowest low point. We've taken out this low that was formed back in July. And this is where, the structure, basically it either kind of tries to pull up here, or it could realistically be going all the way down to 1582 or even lower. One thing about gold, it hates, and I repeat this, it absolutely hates high yields. So if yields continue to go up like they are at the moment, gold will struggle to recover in that type of environment. Let's just do a quick rehash on the previous day, because of course we had a strategy or a concept where if gold had gone through this box zone, then we would be interested in taking buys. Yeah, we stick with that. That's why it's important to have patience to react to a position. At this stage, you could definitely make a case for gold being bearish. I didn't want to sell it through this zone because I know there's so many little potential turnarounds in those previous weeks. And of course, we know it's been a demand level in general. But if you did sell it, congrats to you. And in general, the way that we look at it is you have to find replicable positioning. If you're interested in more things like that, definitely check out the course that we're releasing next week, which is advanced scalping and day trading. And that will really show you how to replicate a concept. It's super important. Replication, replication, replication. You want to be able to do this week in, week out with a very similar strategy and system. And that's super important to do. But yeah, gold's moved over. It's at the lows right now. Potentially we may see structure around here. It's got to find it very, very soon if it's going to. Otherwise, it could be cooked all the way down to 1540s. And I still do have a medium outlook on gold being positive, but I can't be really strong positive on it until we see realistically yields turn. A good proxy for gold would be to buy a big gold miner like a Barrick or something like that. And that's the better way to own it over the medium to long term, or an option or some other kind of instrument. Obviously, you guys practice your own risk management there. Let's go over to another, I guess you would say, potential failure, which was oil. Did we see activation? No. It's very important to wait for that little bit of extra confirmation. It's what changes a good trader to a great trader. And unfortunately, we didn't see that new high. Oil came all the way back down, and it's just kind of floating around in this zone at this stage. We don't really have too many readings on oil. As you know, my medium to long term here is negative on oil over the long term. I would have liked to see it take this level so that we could move towards getting a nice little inverse head and shoulders. It just didn't eventuate. Oh well, on to the next one. Of course, if you didn't activate the trade, it's okay. Tesla, now this is interesting. Tesla actually did hold up very, very well considering. And if you look at the 15th, we were here on this little double bottom. It actually went up into the little zone. So Tesla did okay. It's holding amazingly well. I mean, if you go to a daily here, you can see that rejection off this box area we've had for a little while. That's pretty critical. This is definitely a critical zone. For Tesla, it's really just more about, it's kind of at resistance. I mean, I feel like it's at a take profit zone for a lot of people. This is a bit of a dangerous area. It will need to clear over here. So around, what is this, 318, 320 for me to be, really feeling bullish past this level. And I'd be looking for trap trades towards the downside here. I think that the next couple of weeks could really be negative on markets. And that's just because of the seasonality, because of the tapering, because of everything else that's going on in these markets right now. Let's move over to why I'm actually worried about markets. Look at Apple. Now, while this may not be the straw that breaks the camel's back and it's maybe not falling over completely, if you think about it, Apple just made a new low and closed below it. It swung down. Okay, that's exhibit A. Apple has weakened. Let's look at some of the other big stocks. Check out Google. Does that look like a market that's healthy? Yes, it's back around the previous support levels, previous demand. Yes, we're at that kind of key critical zone. But what if it takes this and goes underneath? Where's the next level for Google? Well, after the stock split, we're talking about like an 86. for a stock like this. Again, not looking positive for some of these big stocks. Meta's the same, or Facebook, whatever you want to call it, because again, advertising is weakening in the US market. Let's have a look at Microsoft on support ahead of this huge options expiration. Big trend line coming up potentially for Microsoft. Many of you would know if you've been following the channel for a while. I really like Microsoft as a company for a longer term hold. I mean, that's my personal opinion. But again, you look at this weakness, previously huge amounts of area, and you've got this strong trend line. It was one of our case scenarios from before. The market is not near lows just yet. Yet these big stocks are all getting dipped very heavily. So the things that are holding up the market are the oversold stocks. The big ones are actually now starting to fall over. And this is a very concerning kind of movement here across these markets. The DAX sitting in the middle of nowhere. We won't really report on this too much. Obviously, we've got the downward trend line. Obviously, we've got our big major support and our key level. That's really just what we've got there. Let's talk about the Nasdaq. So this is where things get a little bit annoying. So as of the previous video, we were here. And the idea was that we would make a new high above here. Or we would swing this and instantly reject and make a new high above here. Everything is about high above here. I want to talk through some scenarios, but we now have a new low formed from previous lows on the futures market for the Nasdaq. So if you zoom this out, we're back at this kind of level here that we reached in the July period. It's now or never for this market to realistically find some buyers. And that's got to do with the S&P 500 and the maximum pain and everything else. So let's just go over to the S&P 500 quickly. Notice the close, 39.01. Key critical levels in the future, gaps left here, and our base case scenario, even for the bulls, which is to get us back into this 3,700, 3,750. Instrument choice here is realistically essential, because even when we're talking about taking shorts or taking weakness plays, we were discussing the idea that next week, that is the week of realistically, not the quadruple witching and everything, was where we saw not that many puts in comparison to this week. There was a lot less, allowing that market to play that seasonality weakness. So if you were interested in taking shorts, one of the ways to do it may have been something like that. Here we've got gaps all over the place, you can see on the S&P 500, but I want to focus in on the futures. Because when we go down to the 15 minutes, you'll just notice that this level is worthy of alerts. This 39.60 zone. The market came up and just shorted off that area. I was looking for this, but I wanted it to go a little higher and then reject. It didn't quite do that. It just kind of got up there and just went bang, straight back down. And for anyone that was in our community, a few people were discussing the idea of this being a little bit of range bound, taking that low and potentially going back to the midpoint. So yeah, in channels, that's a good strategy. The midpoint play is very, very solid. That is, if it takes kind of the high or the low and you see a reason to go in, taking the price at the midpoint is usually the safer technique. A lot of new traders will try to take the price at the other end. The safer technique is to descale your position in here. But let's talk about the next 24 hours. So we're sitting at these extreme lows, 38, 78, 77, whatever. It's made a new low. It's gotten underneath our most important 38.80 area just by a few points. Well, for this to go bullish again, it's really going to need to get past 39.60. And I'd be looking for potential weakness here at this stage, because the market is overall very weak. We knew that. And we were hoping for around that 4,000 to 4,000 kind of 30 closure come Friday. Is it still possible? The answer is yes, it is still possible. Weird things happen over Spooky Friday. It's quadruple witching. Weird things do happen. And this is one of those days where if you're looking at this market, you're thinking, oh, is it worth it? Well, you'll have to see some structure in the morning. I really like something setting alerts around 39.60. I think there's some critical kind of zones there, but let's have a look at the options leading into it. So of course, with the updated information, we'll refresh here. We've got a 404 maximum pain. We've got, which is way higher than where the market is currently. We still have a significant amount of puts sitting at the 380, which is where we're at currently. And we of course have that 390 zone with the significant amount of puts. So we'd like to see the market still end in the pocket around here, which is between that 390 and the 400. Can it do it? We'll find out whether the market wants to do it. It's no guarantee. Maximum pain is just a concept that can be applied. And remember, the reason it works is because if there's enough players in here that are writing these puts, I mean, remember, look how much interest there is. There's a huge amount of open interest. If there's enough profit to be had, the market will do strange manipulation into these events. Think of it this way. The Thursday, the day before markets usually go into quad witching, you'll see that weird shenanigan kind of weakness or strength. And then on the Friday, you'll see that normalization. Will we get it again? We got it last month. We got it the few months before that. I'm not sure. We don't know. But if you see the structure, at least it could help you to get a little bit more bias in that direction towards the right plays. Let's move over here to Bitcoin. What's going on there? 19,740. It just keeps kind of dulling, weakness, slightly lower lows. We're now at that kind of critical low point, and we just probably took the low there. So yeah, we just got underneath 19.5, and it's trying to buy up. It's trying the best it can to hold against that strong US dollar. And some wicks around here, so you can see there is some demand. Look, Bitcoin's just going to go with the rest of the market. If the market picks up, then expect Bitcoin to do a little bit better. You'd be looking for at least to break through something like 20-ish thousand. And I would prefer it above 25 to really bring through that slightly, bigger buy kind of area. But it's weak. The whole market in general is looking pretty damn weak. There's not much to like about most of these stocks other than the quad witching and the possibility of that max pain. If we move over to everything else, remember, if you haven't already started following us on Twitter, definitely consider doing so. We post a whole bunch of things there. We have a Discord, private, and of course a public Discord. And remember, there is still big news coming. We've got prelim UOM, consumer sentiment. And if we scroll through to the next week and scroll down here, you'll notice we have the horror show, the FOMC economic projections, statement, funds rate, and press conference. This is happening Wednesday, September 21. So that's where we'll see this incredibly high chance of a very large interest rate hike, 3.25%, 75 basis points is the consensus. Some people think it's going to be 100. Of course, this is where the real shenanigans will happen. So there's not that many options next week. However, there is a huge amount of Federal Reserve kind of risk. They're data driven, and it's going to be very interesting. Be nimble, be fast, and of course, practice risk management whenever possible. If you do enjoy these videos, remember to subscribe, smash that like button, guys. And of course, remember to check out the link description down below to find out more about the sponsor of today's video, which is Tiger Brokers. They've got a whole bunch of special offers for different people around the world. And if you don't see your country there, you can always contact the Singapore office. Sometimes they'll be able to help you out. Thanks so much, guys. We'll see you in the next one. Bye for now.